Hello, everybody, and welcome into Commodity Culture, where our goal is to make you a better investor in the commodities space. Today, I am joined by the founder of Momentum Structural Analysis, Michael Oliver, a legend in the finance game who has been in the commodities space at a professional level since 1975. Gold is at all-time highs right now and climbing, but in the meantime, not many are paying attention to silver, which will be the focus of our discussion. Today, we're going to talk manipulation and is it coming to an end, the road to $50 silver, and how Michael personally is playing the silver trade for maximum gain. So without further ado, here is my conversation with Michael Oliver. I want to start with your overall assessment of the silver market as we sit here today. Silver has put in a strong performance, closing in on $35 an ounce, but has corrected down to $32.65 as we speak today. The silver miners also taking a bit of a dive. As long-term silver bulls, isn't this something we like to see? I'm hoping for a bigger pullback personally so I can add to my silver mining stock position. But as you mentioned before we hit record today, silver is still up massively year to date. So give me your thoughts on the silver sector at present.
Well, I still personally, and MSA expresses this in our analysis, the monetary metals are in a bull trend, and now they're in an accelerated portion of the bull trend. Now, you can argue, when did that bull trend begin? We defined it in February 2016, a couple months off the low. We said, that's it, it's going up. Bull trend, annual momentum broke out. Price didn't, but momentum did. But then it labored for a couple years, between 1360 price, and it even probed back down in late 2018 to within almost 50, 60 bucks of the prior low that occurred in 2015, which was around 1,050. So then in late 2018, you pushed up through that price base, 1360, call it roughly, and price really broke out. So you can define it there. Maybe it started in late 2018-19, but we defined it as early 2016. Okay, forget that. It's aged compared to a couple other bull markets we've had in the past, which were 8, 9 years old, that kind of thing, mid-70s to 1980, the 2000 low to 2011. So it's a decade involved there. So we're now 9 years, but we have different fundamentals than we've ever had before. And we've also got better technical dynamics. So I think silver is at some point going to engage in a way that will drop jaws, in terms of its performance to gold. We call it a little dog on a leash to Mama Gold. Mama's holding a leash, and silver will run ahead of it, and then silver will run behind it. Today is the behind day. Silver's down more than gold by 1% or 2%. But that's common. It's been common for the last couple of years, where silver does follow gold, but it goes ahead, goes behind. There's a point at which, though, not far above current spread levels. And what we do is we measure the price of silver versus gold in terms of dollars per ounce versus dollars per ounce. So right now, silver is about 1.23 or something, the price of gold, 1.23%. If you get up to about 1.3%, we've got technical reasons to assume you're going to blast. In other words, the silver-gold spread will unleash, not just for a few days, but probably likely months, several months. And that's what occurred in 1979 in the final year up to 1980 peak. And it also occurred in 2010-11 in the final year up in that bull market, where silver broke out on its spread basis versus gold and really unleashed. So yes, it's attached to the leash held by gold, but it can really pull out in front. And it tends to do that in the very dramatic phases of the price rise in both metals. So if that spread breaks out, and we think it's headed toward the breakout level again, roughly 1.3%. You see it up to that level where you divide the ounce of silver, the December silver and the December gold, and you come up with 1.3%. Put your helmet on. Because at that point, I think silver is going to engage far more dramatically than gold. I think we're going to do it. We're still below that level, but it's a level to be watched. And it will engage price as well, not merely the performance difference between the two.
Hey guys, quick break to hear from today's sponsor, ARC Silver Gold Osmium. They offer personalized service and competitive prices with no minimum purchase. for silver, gold, platinum, or osmium. Here's just some of the comments left on this YouTube channel about ARK SGO and owner Ian Everard. Have bought from ARK, good source and price. I cannot say enough good about Ian and his company. He is the most honest individual I could find in order to buy precious metals. If you are looking to buy precious metals, I recommend Ian at ARK Silver. He is a straight shooter. So go to arksgo.com and contact Ian Everard today at 307-264-9441 or by email at ian@arksgo.com, and make sure to tell him that Commodity Culture sent you. So with today's drop in silver and gold as well, of course, we are going to hear cries of manipulation. They're tamping down the price. This always happens on social media. Interestingly enough, it happens a lot in uranium too, not the market manipulation argument, but just the thesis isn't working. Everything's falling apart. Uranium stocks are also down a lot today. Whenever I hear these outcries on social media, I always check the NASDAQ, the SPX, and today they are also down considerably as well. I want to get to the manipulation question in just a moment, but first, I'd like your thoughts on the broad market at present. Before we hit record today, you also said there's a lot of downside to come. What are you seeing right now when it comes to the broad market?
I think the S&P and the NASDAQ, and this is true with some other indices around the world. We've looked at the DAX index in Germany, Nikkei, Sensex in India. They all have technical vulnerabilities by our momentum metrics. Not the price chart doesn't show it. S&P right now is starting to break some annual momentum trend structures. Quarterly momentum trend structures, meaning when you measure its month-to-month action in relation to a three-quarter moving average, which is a fairly long-term average. It's like almost like a 200-day in terms of the duration, the size of the metric. You're breaking a structure now that goes back a year or so on that quarterly momentum, such that when you trigger that, and right now you're at levels where you close the week here, you're triggering it, okay? You're going to unleash to the downside. Now, I don't think you're going to crash. I think we're headed into a major next downturn in the stock market, which I think MSA argues that the 2022 highs, which have been exceeded by double-digit percents, but it took them 2 years to get back there, and then finally they took it out. We think that takeout of those highs is a trap. It's a mega trap. It has generated the forever upward sentiment, and we think all it's done is extend the bubble. This is the biggest stock market bubble in U.S. history. You can go back to 29, look at that high. It was a four-year bull market, or 6-year bull market from the 23 low, but it only doubled or tripled in price. You go back and look at the 2000.com peak. That was from about 1994 to about 6 years, okay? And the S&P doubled or tripled, okay? Then you go back to 2002 lows to the 2007 high, 5 years. S&P doubled. Those were the prior bull market peaks that led to collapses that generated pain, not just to stock investors, but to people in the real world. Okay. We've had a bull market since the 2009 low. Okay. More years than ever before. And the multiples are off the page. S&P's gone up 7-8-fold. NASDAQ's gone up 16-18-fold. Okay. You've never seen those kind of dimensions. Now you could say, oh, it's good economy. Well, look at M2 and see the rapid money printing over the last decade, for example, compared to prior decades. And look at the Fed funds rate for the last 15 years. And where 10 of those years were at zero. Okay, free money. Okay, that has caused a bubble. The boom-bust cycle is a monetary phenomenon. When it breaks, the errors will be exposed. And at that point, that's when the monetary metals go absolutely berserk, because this time the bubble is bigger than ever. And this time around, we also have a crisis in debt involving U.S. government. It's no longer just mortgages. So watch the stock market. There might be, and we think there will be, a flash from the T-bond market to the upside where yields actually drop. Right now they're rising. Despite the Fed cut in September, bond prices have come down sharply. That has no doubt unnerved the Fed. Stock market now starting to break will cause data points to cave next month, the following month. That's what happens. When the market goes down, then the data points shift. The Fed will panic. Gold knows that. What does it mean? Further monetary expansion, drop in rates below where they might otherwise be in a free market. And this is true not just with our central bank, but the ECB, the BOJ, et cetera, et cetera. So gold knows there's another monetary infusion coming, meaning further degradation in the value of the money. Okay, that's what gold lives on. Okay, so ultimately, watch the stock market. It was a good point you made, because if it cracks, and we think it's about to blow major structures that should cause a layered sharp drop, not a 35% drop in 2 weeks, which is a crash. We think right now you could get a 10 or 15% drop in the stock market quickly. That's not a crash. Right now, one of the problems with the gold and silver investors is they have this syndrome that, oh, if the stock market goes down, see, like today, for example, gold and silver must go down. Don't bet on it. You go back and look at the 2007 bull top in the S&P, by the way, which occurred 1 month after the first rate cut by the Fed, a surprise rate cut in September of 2007, just like September of this year. S&P went up for the next month, and in October peaked. Okay, well, did we just peak in October, a month after the Fed cut? Anyway, we have momentum structures that say the U.S. stock market and other markets could cave very sharply and move money out of that category into the place that's working the best. What is that? Monetary metals.
Well, I do want to touch on the manipulation question because, every time silver corrects by 50 basis points, everybody's screaming manipulation. That doesn't mean that it doesn't exist entirely. I've had Mario Manecco on the show a couple of times, and he's laid out a very compelling thesis for the manipulation of both gold and silver markets. I'm wondering what your thoughts are when it comes to the manipulation question. Mario seems to believe that at the moment, there are several organizations, bullion banks, Wall Street firms, central banks involved in suppressing the price of both gold and silver. And when it comes to the reasons why, his ultimate end game is that it is because they do not want the public to be holding real money in their hands, especially in the case of a fiat currency collapse. How do you see things when it comes to that manipulation question?
Well, I can't deny that it's occurring, and we know in the past it's occurred. You go back to the 79 bull market in gold, the IMF was dumping gold by the tons, okay? Sale after sale after sale, dumping gold. And it initially in 79, as I recall, and I was in the futures markets then, there were sharp drops when the IMF would dump. But there was a point at which they would dump and it wouldn't drop at all, it would go up, okay? So there's a point at which reality can't be distorted even by the superstate, okay? They think they can, and yes, they do temporarily. And my son Brett has noticed that when you look at the hourly action of the S&P, of the silver and the gold markets, you look at this morning, for example. When do they beat it up? It's always in the dark as you're about to go to daylight. Early in the morning when they open the futures market, they've already dumped on the market during the night when trading is less volume. And you get these huge down hourly bars. But it always occurs like in the dark, when they can manipulate easily. Ultimately, that's going to backfire. And also stand back and look at it. I've got some charts showing year-to-date performance of the markets. And you see the S&P and the NASDAQ up, 10, 15%, pushing on 20. They're backing off right now. They were near their highs. It wouldn't shock me at the end of the year. They're down on the year. But silver's up 35%, gold's up about 33% on the year to date. Okay, so despite the manipulation, which you can probably see in daily action, maybe today, for example, look at the gains they've made. So really, it's not working. If it were, gold wouldn't be up 30+% this year. Silver up 35. So ultimately, there's a point at which that manipulation doesn't work at all. And market just blows through them. And ultimately, the manipulation likely compresses the volatility that later is unleashed. Where if reality is distorted and you've kept reality from emerging, when it finally does emerge, it's more volcanic than it would have been if you'd let it alone. Okay, so actually, it's probably bullish for gold and silver investors that the central banks think they can play that game.
Yeah, that's a very good point. I want to discuss the industrial side of silver. We hear a lot about silver in solar panels. There's several people who I've discussed this point with, Chen Lin, Peter Kraut, many others. It seems to be a little overhyped, that particular segment of the silver market to me, partially because I believe the new green economy isn't quite going to play out as governments believe it will. Nonetheless, I could be wrong there because it seems like they're going to push forward. There's a lot of government subsidies behind solar. China obviously becoming a very big player in the manufacturing of photovoltaic solar panels. Maybe let's separate hype from reality here. How much will solar actually play a role in silver demand in your mind moving forward?
Well, from what I see, I think it's quite legit. And I don't think it's a green issue so much, as you said. Yes, in the US, it's a political issue. But when you're in, let's say, in Africa, in undeveloped parts of Africa, you don't have electric power companies with a wire running to your house, okay? And you've got a cell phone, or you want one, and other things you've got at your home. You need a solar generator in your backyard, solar cells and an electric generator. China is catering to that emerging market situation where there is no centralized power authority in much of Africa and in large parts of Asia. And they're catering to that. And as those economies demand electricity, the best source is solar power. It's cheap too, relatively speaking. Prices have been coming down, and silver is an essential component to it. So, and from what I've seen, the industrial demand based on that is rising dramatically, double-digit percents every year, whereas silver production is flat at best and really declining slightly annually, year over year. And from what I understand also, China has really come into the Central American silver production and monopolized it. And I even understand that they've been paying prices for raw silver ore that's equivalent to purified silver. They're really strongly demanding it. And it's not for monetary issues. It literally is. They're 80 to 90% of the production of solar panels and voltaic cells. So I think it is really a thing that will spring on the public. You and I know about it because we're in touch with the industry, but I don't think the average Joe on the street is aware of that. And it's one of those kind of things that could help separate silver from gold, because gold is monetary solely and silver has this industrial aspect. And to the extent that uncertainty hits the world, and we think that's coming, stock market drop will facilitate that in some ways. Also, jeopardy of bond markets will facilitate that in some ways, in a sense of nervousness. I need to protect myself. Even here in the U.S., where families, like in Texas, they're tired of the repeated hurricanes knocking power out for 2-3 weeks. So demand for solar cells, even in the U.S., is strong. And I think that once you get, the political instability we're about to see is something we predicted about a year ago. We can get on that later. Provokes emotion. And when stock market starts to break, that will really provoke emotion. Not just economic pain as rising commodity prices have done, but if suddenly you take 20% off everybody's retirement account or 30% off, they're getting hurt badly. They're bleeding from both ends. And that generates emotion. When you generate emotion, you generate factors that we don't normally incorporate into market analysis. You generate dynamics, downside for the stock market, and a movement toward things that make you feel comfortable. In the case of monetary, where you want to put your cash, what kind of cash do you want to keep it in? Bullion or paper that's evaporating in value? And in terms of your sense of confidence that you have electric power tomorrow, on a sense of instability. What the heck? $3,000, you can buy a generator that's solar powered that can generate most of your appliances. So even in the US, that demand could be sparked. But I think it's real. I think it's a real factor. And yes, it's been hyped within the industry and analysts like you and I. But the average public that's not a factor in their mind. And if all of a sudden you hit them with that gives them an extra excuse to favor silver over gold. And I'm going to suspect this. We think the advance in silver, which again wobbled today, continues. You take out the recent high, for example, at 35. Yet again, we do that. We make a high and goodbye, and it's not goodbye. You take it out later. We're at that threshold where if you get that silver gold spread up to that 1.3%, which to us is a neon sign saying I'm going to accelerate, I think silver's going to take out its dual highs at 50 and do it in a flash. And once you do that, suddenly the public then wakes up, who've not been paying attention to silver. Their buddy has, their next door neighbor has, and he's been telling them stories and they didn't do it. And all of a sudden they have a sense of uncertainty. That's when silver gushes. And all of a sudden, I bet at that point in time, that's when those type of headlines about the industrial demand for silver hit the fore and will add to its fuel. Not spark it, but add to it after you've had the surge. Anyway, we'll see. But I think it's a real factor. Yes, I do.
Well, speaking of Joe Sixpack and their knowledge of silver, we've seen some interesting developments like Costco starting to sell silver bars. It was very interesting. My wife's mother messaged us from Japan. They've got silver bars here. Should I buy them? I've already got her parents buying gold and silver. But I still think the average member of the public still views silver as kind of something obscure, more like a collectible or a really alternative investment class. You mentioned some factors that could potentially wake people up to silver's value. Obviously, gold is the preferred safe haven asset of central banks. I think most people find buying an ounce of gold to be too expensive, especially if they're struggling to make ends meet. What do you think it will take to wake up your average person out there that, maybe I should take a small portion of my paycheck and buy a few silver coins now and then to protect my purchasing power and to kind of store wealth outside the traditional financial system?
I think that stock market break, despite what the popular wisdom is among most investors. You break the stock market, gold and silver go down. That is simply not true historically. 2000 to 2002 bear market, the stock market, gold went up nicely, so did silver. 2007 to 2009, with the exception of 1 month in October of 2009, gold and silver went up sharply. When the stock market collapsed in October 2008, everybody said, oh my God, I sold gold too. Well, gold was ripe for a technical correction, even by our metrics then. It corrected quickly, and within about 4 or 5 months, it was back to its high. S&P kept going down through March of the next year, and it took it a year or two to get back to its high. So everybody's fixated on those momentary times where they could find 4 weeks here or there where gold went down with the stock market. They don't see the bigger picture. And frankly, this time it's different. If you generate that fear and you hurt people, literally hurt them, with the retirement accounts dropping 20%, 30%, and you give them a sense of fear on both ends, the cost of living and their savings are gone. I'm already getting emails from quite a few people saying, I'm moving from cash savings over to bullion savings. And, I think that's already going on. And when you crack that stock market and create the negative sentiment and the emotion that goes with it, people will seek something that's going up. Even if they don't quite understand why. Their buddy did it and it's working. They're going to move money into bullion savings where they feel comfy, that they know that their savings aren't going to deplete in buying power. But I think the stock market actually is a positive factor for that, not a negative. We shall see. But I think that factor is about to come into play, and probably rapidly.
So gold is starting to get some mainstream attention. There was an article in CNN a few days ago, something about the gold bull market is here, how to play it. Some other talking heads on financial media have been covering it. We've seen Paul Tudor Jones and Stanley Druckenmiller both take positions in gold and gold equities recently. Do you see silver, by contrast, being in sort of a stealth bull market that won't fully be appreciated until it really starts ripping? As you said, it could take out previous all-time highs in a flash. And at that point, will we start to see the talking heads and perhaps some of these big-time investors start to discuss silver and perhaps deploy capital into the space?
It's probably going to take a jolt like that. They're not going to, some of the smart asset managers are already making the move into the miners, for example. Newmont, for example, a big blue chip. And, there's some arguments against it in terms of, whatever, corporate management, whatever. It dropped sharply recently in earnings report. But still, it's in a 47, 48 area. And back in February, when like Druckenmiller started buying, it was $32. So, he's even up nicely since February, despite the recent drop. But the gold miners in general and the silver miners are behaving well. They're not, at this point, fully outpacing gold. We think that will occur. Uh, and I think, again, the most prominent technical I'm watching literally is that silver gold spread. Now, I know a lot of people look at the ratio in different ways, and they treat it as a secondary indicator. I treat it now as a primary indicator because historically, when that guy moves into a breakout mode, and we have over the last couple of years, if you plot that spread, there's numerous rallies that go up to like 1.3% silver price per ounce versus gold price per ounce and pull back. You don't go back there again. You go back there again, you're going to blow through that structure. And it's like 2.5, 3 years wide. If you looked at the chart, you'd say, ooh, that's a price chart. I want to buy the breakout. You're going to gush silver up to a couple of percent versus gold. Now, let me say this. You go back 50 years and look at that spread. Where has it been during those 50 years? 21 of those 50 years, silver's been at least 2% the price of gold. That's almost a norm. And during the big bull surges, it was 6.5% in 1980. And in 2011, it was 3.5%. So that spread surges. But even just to go to a routine, normal 2% level, which when you looked at that graph going back 50 years, it's just gone back to a normal 2%. You do 2% times gold at 3,000, let's say. You're talking $60 silver. Okay? So watch that spread, because when that spread gets back up near 1.3% again, you're about to ignite both markets in terms of not just the performance of silver, but in terms of its dynamics in price and gold's price. It'll be beating gold, but they'll both get more dynamic. And I think it's at that point when you get those price rushes, and I'm betting that when that occurs, it will be partly due to the factor of the stock market causing a motion the other way and assets moving somewhere. The somewhere that's looking good. Well, right now, what's looking good? Again, look at that year-to-date chart I sent. That's silver and gold are outpacing the heck out of the stock market. And there's hardly any asset that matches them. And yet, yes, the press is finally acknowledging gold's a bull, but they're not beating the table about it. We don't have a fever yet. And the tone of gold, you look at its price action, it's not vertical like that. It's not parabolic with gaps and so forth. So we're not in that stage yet.
I want to get your thoughts on the upcoming election in the U.S., perhaps one of the most polarizing in recent history. This episode will be posted on Friday, November 8th, so that will be after the election. However, I've spoken to some people who believe we will not get a decisive candidate elected, but by that time, and it could take even until December or something like that to figure out who actually won. We've seen a lot of posts on X about potential shenanigans going on, ballot boxes being lit on fire, things of that nature. I mean, it's hard to tell what's real and what's fake when it comes to social media, but I'm wondering what your thoughts are on the effects on markets and the economy should either Trump or Harris win. Do you see much of a difference between the two in terms of the impact on markets?
Well, here, I'm going to show you. This is an MSA report that we put out in December of last year. I'm going to bore you. I'll read a few sentences only. The title of the report is Tabula Rasa Factor. Tabula Rasa. Wipe the table clean. Okay. Headline: there is no outcome to the 2024 election. Again, this is December last year. That will lead to a calm social order, calm politics, calm in the streets, and therefore, quote, normal markets in the wake. Now, that's about all we said. But then on the next page, what we did is we quoted from University of Virginia Department of Politics, which conducted a poll October of last year, so a full year ago. They polled likely Biden voters, likely Trump voters. Of course, it's now, not Biden, but still same thing. Their questions were very pregnant and to some extent overlapping to sort of check the validity of the answers they got from one of the questions. They'd ask it in a slightly different way, and it got validated over and over. I'm quoting from them now. A staggering majority of both Biden and Trump voters believed electing officials from the opposite party would result in harm to the U.S., and this is a quote from them now. Roughly half, 52% of Biden voters, this is back a year ago now, 47% of Trump voters viewed those who supported the other party as threats to the American way of life. Next thing, 40% of both groups, 41% of the Biden voters, 38% of the Trump voters, somewhat believed that the other side had become so extreme that it would be acceptable to use violence to prevent them achieving their goals. Okay. A significant number of the respondents also expressed doubts about both the future of democracy and even the United States as it is currently composed. Roughly 2 in 5, 41% of the respondents of Trump and 30% of Biden voters thought that seceding from the U.S. would be justified if they lost. Okay. It's been a year. Do you think those numbers have come down any?
No, they've gone up, I'm sure.
Now, again, I'm not going to say, oh, which side is going to be. Everybody assumed that if Trump loses, it's going to be violent. Nobody's talking too much about what if the other side, what if he wins? I mean, we've been told for a month now he's Hitler. And if you believe that, on public TV, I saw an episode the other night on public TV where they spent 15 minutes not talking about the campaign back and forth, what Trump doing today, what she doing today. They had an academician on there explaining how he is a fascist. 15 minutes on public TV. Okay. Now, if you believe that and your side lost, what do you do? I don't know. But I mean, I guess they're just going to go quietly away, right? Okay, I don't know. But anyway, so the outcome is highly unlikely to be copacetic. Now, is that built into the stock market? You tell me. I don't think so. Is today maybe the start of it? This is, again, is October 31st. We're starting to see some breakage. Is that the beginning, starting to hit some of our trigger levels? Is that the beginning of something noisy? I don't know. But that's a factor that's not priced in. And I don't care who wins. I don't think it's going to be copacetic.
Very interesting. And my stance is I hate all politicians. I always get flack in the comments if I say anything against Trump. I don't know what's going on with my viewers.
As you know, I'm a libertarian author, and I'm not even voting, okay?
Well, there you go. Yeah. I mean, I guess I would vote for Trump if I was American, gun to my head, but I hate all politicians, and just let it be known. Don't attack me in the comments because your chosen political savior is not my favorite. One thing both candidates don't seem to be focusing on is reducing government spending and getting debt and deficits under control. Are we in an economic doom loop regardless of the election outcome? And would that sort of situation fuel gold and silver?
Well, ultimately, we have a crisis now. And now let me explain our situation. Technically, we analyze markets, and I set aside any philosophical views I might have. They don't always play, okay? Ultimately, they might, okay, where free markets finally ascend. But market movement isn't always rational. So we analyze it technically. The T-bond market has been in a bear trend on annual momentum for several years now by our metrics, meaning very long-term momentum broke major uptrend. In fact, you could see it on a yield chart. Go back decades, you'll see it was an upside breakout. Case of price, it was a downside breakout. And we've had some rallies over the last year or two where it's trying to base. If you look at the price chart, you can see sort of like basing action. Well, our momentum of quarterly action of T-bonds indicates there could be a counter trend rally here, counter to the major annual negative trend that could spike T-bond prices up. And if you look at what T-bonds have been doing since the last 6 weeks, while the stock market's been going happy because of the Fed cut, bonds have been going down. Yields have been rising on the long end, despite the Fed cut. That is a market that will panic the central banks, and we know there's a debt crisis coming. Paul Tudor Jones just recently came out and said the real crisis is the government debt. He's right. The question is, when will it show itself to the point where it generates maximum panic, not just by investors, but by central banks? Because that's one asset they cannot have continue to go down, yields go up. They must do something to stop that. And if government spending doesn't change and that debt to GDP ratio continues to stay high, the Fed's going to have to just print to buy that asset to keep it from going off the page. Or I don't know what the outcome is, but it's going to be maximally noisy and bloody. And that's one asset. Like back in the 2007-9, it was mortgages. 2000 to 2002, it was the dot-com bubble breaking. This time you're talking about debt of central banks. And if that ever comes into jeopardy or is perceived to be in jeopardy by people who own the stuff, not just by analysts who are wise enough to see it coming, then you've got a crisis beyond crises that will create monetary panic like we've never seen. And things that will cause what? investor maximum panic and fear. And if the stock market's not behaving well and the T-bond market's not working, what are they going to do? Now, the problem we've got technically is that we still see the potential, despite that likely major downside in T-bonds, rise in yields, the panic in the bond market due to the debt thing. There's a potential here that if the stock market starts to break now, we could get several months of a rally in T-bonds, which would surprise most of the negative guys out there. In fact, even Bank of America, an analyst came out a week ago and said, do not buy U.S. Treasury bonds. Bank of America? That's part of the system, guys. You can't say that. But they said it. And there's many other analysts who say, do not touch those beasts. Well, they look like they're right now, but there could be a point in here for a couple months where the T-bonds do get some of the asset flow that moves out of the stock market into a, quote, perceived safe asset. It's not safe ultimately, but it might be for a few months. So we wouldn't be shocked to see T-bonds have a flight to safety rally as the stock market starts to break. We don't trust the rally to sustain, but it could confuse people. Ultimately, we have a debt crisis, T-bond crisis. And I think, again, that's what gold knows.
Let's talk about some areas outside of the gold and silver space that you're seeing value in. You cover a lot of different commodities at a Momentum Structural Analysis. You talk a lot about the energy markets, agriculture. I've been pounding the table a little bit on fertilizer stocks. I'm wondering what your thoughts are there. The major fertilizer stocks seem extraordinarily undervalued to me at this point in time. Where are you looking for value outside gold and silver?
That you just named one. The fertilizer stocks is one sector we like. It's related to the ag markets. The ag markets, just look at Bloomberg Commodity Index, for example. Everybody thinks, we had high inflation in commodities, in 2022. Actually, Bloomberg got up to 140. But if you look back at its highs in 2008, it was like 270. And in 2011, it was like 170 or something. So we got up to 140 briefly and collapsed back down to 100 area. We've been either side of 100 for a year and a half now. It's Dollsville. It's not going lower anymore. And it is leader to the data points the Fed thinks, we've brought inflation down. Heck, Bloomberg said that a year ago. And only now are their, quote, inflation numbers finally reflecting what Bloomberg said. Our assessment of the overall Bloomberg Commodity Index is this is a base. And the next major move is upside. The energy complex reflects that. Yes, it got beat up big from the $130 oil high. We got down in the high 60s, and now we're in the 70 area, either side of. But it's been basing for a year or so as well. Not going down, just up, down. Grains, major drop in price since 2020-22. Not back to the lows in 2020, but major drop. And then Dullsville for like a year now. That's a basing action. We see it on momentum. It wouldn't take much on the Bloomberg Commodity Index for it to flip out of the basing action and go into positive mode again, like 2-3% higher than we're trading right now, and it will do that. Most of the components within that look like they'll join in. Copper, base metals, the energy complex, but I think especially food this time. I think especially grains. They all look to be in unison right now for a uniform upturn. And I think that's where you see in that sector, fertilizer sector, a good potential for gains. So if you don't want to buy commodities, fine, I understand that. But the commodity-related stocks look like a place to be in the stock market. Maybe you go market neutral, sell the S&P and buy the ag-related stocks. Probably make a lot of money. Fertilizer stocks look like one of the optimal places to be.
Absolutely agree with you. Fantastic conversation today, Michael. Thank you so much for coming on and sharing all your knowledge with the audience. Tell us about Momentum Structural Analysis, what it is you do there, and where people can find it.
Well, we've been doing it since 1992, and initially for the first 10, 15 years, first 20 years, we only had institutional clients. We opened it up to retail subscribers in 2016. And we have a all asset category report. We put out about 5 reports a week, a big weekend report as well. We look at all the major asset categories, especially now it's very important. We look at the stock markets, not just U.S., but foreign markets, foreign exchange, which is dull right now, very dull factor, but it's about to become noisy. I think the dollar's about to cave. but it's been a dull factor. Commodities in general, emphasis gold and silver, and the debt market, T-bond market. You need to look at those, even if you're only focused, let's say, in gold. You really need to pay attention to these other factors because there are times in history, and I think we're in one of those, where what the stock market does could generate movement of assets into gold. What the bond market does could generate movement into gold. What Forex does, it hasn't done anything for a year and a half right now. It's been a 6% range for the dollar index. Those are tectonic plates. When they move, will impact monetary metals even more so. And I think once certain of those categories start to really crack, like the stock market I think is about to, that's going to generate further fear and therefore asset class movement. So that's what we look at MSA. We try to give you a broad view so you have a sense of the full picture, not just what's in the windshield, but look out your rear mirrors too, because what's going on there is very important. And we think, frankly, I'm not trying to hype it, I think we're in one of the most fantastic periods in history, market history, where the volatility and violence in the markets is going to get headline nature. And I think we're about to enter it right now.
Well, I'm going to put a link in the description below to Momentum Structural Analysis for people who want to check that out. Thank you once again, Michael. Always appreciate our conversations and look forward to the next one.
Jesse, thank you.
And thank you for joining us today. This episode was sponsored by ARC Silver Gold Osmium. For all your precious metals needs, head to arcsgo.com and contact owner Ian Everard today at 307-264-9441 or by email at ian@arcsgo.com. And make sure to tell him that Commodity Culture sent you, and I'll see you guys in the next episode. Commodity Culture is a series on commodities and natural resources. If you would like to see more, be sure to subscribe and hit the bell notification so you're always up to date with the latest episodes.